When the spread between the 3-month and 10-year Treasury note yields inverted on Friday for the first time since 2007, some investors panicked. But are these recession fears valid? Joining us now to discuss is Peter Borish. He's Chief Investment Strategist of Quad Group. And Peter, I actually want to start with Lululemon, which we just had come out with earnings, and they look pretty good. And I don't know if you know, but they charge a lot for their pants and any other stuff that you buy there. It's expensive, sure. And the consumer is paying for it. Their margins are doing well. You think that the death of the consumer is premature. Is Lulu the kind of company you're looking at to tell you that, or where else are you looking?
Well, first of all, thanks for having me. I love the new studio.
We do too. Right. Thank you.
And, you know, when Lulu starts making suits, I guess I will be going there a little bit more often, but they don't at the time. But what it indicates to a certain extent when you compare Lulu to other consumer brands is the fact that the more well-off consumer is continuing to chug along. And I think that the spirits with the rally in the first quarter that we've seen in the equity market, give or take the last few days, you know, there's been very, very positive sentiment. And, you know, people are trying to read into the negativity associated with the yield curve. Mm-hmm. But as I always like to come on here and throw some little curveball with the start of the Major League Baseball season starting, is the fact that the 10-year to 30-year, that has really steepened. Mm-hmm. So there's, as usual, these things are not as simple as, you know, the headlines would appear. But Lulu blowing it out was amazing.
So when we look at the U.S. economy right now and the state of the consumer, if things are in good shape, let's go back in time 3 months in market history and just sort of say, like, what do you think investors were seeing at the end of last year? Was it technical selling? We've had people come through here and say, oh, it was technical selling and there was lack of liquidity and don't worry about what happened there. But obviously investors were concerned about something, and some of those fears have been quelled to some extent. And I guess the only obvious culprit would be the Fed. They changed their mind, and so then everyone said it's going to be fine.
So I'm not such a subscriber to that theory. And by the way, as a chief strategist, after the fact, I'm always right. So now that we're talking
as media
about
members, we're always right after the fact too.
Now that we're talking about 3 months ago, I think it makes it a little easier. I thought you were like trying to discuss the next 3 months, which would be far more difficult, particularly if you had me back in 3 months and you pointed out every place where I was wrong. So the Fed was known. So the issue is, in the short run, it's a supply and demand for money. And when you go back to the fourth quarter and you look at that and the things that we were speaking about just today about the death of the consumer, we looked at Visa, we looked at American Express, we look at MasterCard. And I like to say, in the new economy, whether you're going to the store or you're shopping from the couch, they benefit.
You're still shopping. Yeah.
That's correct. And you're using some sort of credit instrument. Those stocks broke down in early October, and I was here, and we discussed that. So yes, it was a combination of technical, but it was clearly uncertainty and selling. Now, we can just say, well, was it political? Was it economic? Was it the Fed? I think that if everything is driven by the notion that the Fed was going to tighten because the economy was strong, and now that they're not doing it, and you have the new appointee to the Fed saying they should cut by 50 basis points immediately, that makes me, as a consumer and more so as a hedge fund manager, particularly nervous, because what are they seeing about weakness that we're not seeing that's not already priced in the markets, which is why I say, let's see what happens in 3 months from now.
Right. Yeah, Peter, I know you're joking about trying to prognosticate the next 3 months, but let's talk about kind of the next 6 months or the next year even. I mean, we're waiting. Let's just specifically focus on U.S. equities. What are the factors that we're anticipating that could really put some juice back in the markets? I mean, obviously there's U.S.-China trade war, right? But then, you know, we're hoping to see an end of tariffs for good or some kind of deal on that front. We know that that would probably be very good for stocks. On the other hand, there's political risk, right? We have 2020 coming up. We know that that's going to get very controversial, but maybe the markets don't care about that. What are kind of the biggest things that could happen that would be great for stocks in the next few months?
We feel that currently the market's a bit ahead of itself on optimism with it relates to China. We look at two things. We look at markets. So let's just take soybeans, for example, which we've been talking about for a long time. That just made new yearly lows today. If there was going to be some pickup, you would think that that would have some suggestion in that price. From a game theory perspective, just as you talked about the election in 2 years, China, why are they in a rush? If there's going to be a change in U.S. leadership, what's the incentive for them to sit there and go, oh, let's get this done. In fact, it's more likely the opposite, that those that are running for re-election have a greater incentive to get it done than China has to get it done. So I think there's a potential conflict. The market is ahead of themselves. So if you look at exporting, if you look at 3M, if you look at Caterpillar, those haven't really rallied. And then, oh, by the way, all the financing instruments that's related to that, never mind the addition of the yield curve inverting. If you look at the regional banks, so those that would be in the Midwest that would have been supported by growth, those haven't benefited either. And finally, U.S. GDP is well below expectations. Just let's add into the fact that we're already starting to get into debt ceiling negotiations with a divided Congress. It's going to be a fun period.
It's all bad.
No, it's all interesting.
It's all fun, yeah, I agree.
You're a professional trader, a hedge fund. For your regular retail person, would you try and take some profits here? What would you do? What do you advise?
Well, it's hard for me to give individual advice, without understanding everybody sort of where they are in their own personal financial cycle. But yes, it never hurts to ring the cash register if you've had a good run and to look back, because it's amazing how less emotional you are when you don't have a position on and you can be objective. And there's a lot of cross currents. Yeah. And so, again, if you think that the orthodox top in the stock market was last January 26th, and markets take a long time to make highs, that this period has been a big tug of war, and it's going to resolve one way or the other. Patience, I think, is a virtue.
Also a big word for the Fed. Peter Borish, Chief Investment Strategist at Quad Group. We'll see you again with your Lululemon suit. Maybe.
Oh, you just wait. For sure. It's coming.
Maybe Chip Wilson's been on the show. Maybe he still has a large stake. He'll put a word in.
I'm happy to be a guinea pig if you're listening out there.
See you soon.